Every day new information comes to light about the unfinished business from 2008 and how it could easily erupt into the financial crisis part 2. Sadly, nothing was resolved before the stock market started to move higher. No serious measures were taken. Nothing was done to prevent the next recession. As long as the stock market moved into positive territory, the public could be fooled. You came here for the truth, so let me unveil that for you. Today we're going to look at some warnings from high-level individuals. I've got charts, I've got articles, a lot of information to cover in this jam-packed episode. Stay with me. I want to begin by taking a look at this article out of The Guardian. They did an interview with Gordon Brown, and this individual here called for the New World Order on several occasions. I've done videos about it in the past. He had some interesting things to say. I wanted to bring that to you. A leader of this world is sleepwalking towards a repeat of its near meltdown in late 2008 and early 2009 because it had failed to remedy the causes of the financial crash a decade ago. I completely agree with this here in that they did not resolve the underlying issues. This has been what I've been talking about for years. I covered it in my books, I talked about it in my videos, and now we have Gordon Brown saying that. Now, his solutions to the problem of a new world order and so on are not exactly what I would agree with, but at least he's pointing to the problem, all right? He said this: we are in danger of sleepwalking into a future crisis. There is going to have to be a severe awakening to the escalation of risks. And I agree with that wholeheartedly. Again, not with his overall mandate, but at least in this case here, I definitely see the risks that have emerged. Brown was instrumental in creating the G20. A body made of the world's leading developed and developing nations, but said that the cooperation helped to avoid the Second Great Depression had been replaced by a world in which countries had retreated into nationalist silos. I don't think that this is true, and that's the reason why we will have a problem. Of course, that's really not the case. However, he makes some very interesting points and saying that, look, if you're not going to fix the problems we had previously, it's just going to be an even bigger problem this time around. There's more debt, there's more leverage, there's more garbage in the system today. It may not be in the same derivative products we had 10 years ago, but there are new things. There are shadow banking. There is all kinds of schemes that they've developed ever since. Every year that goes on, there's a new scheme. And that, of course, will only exacerbate the issues. We don't know if it's going to come from left field or right field, but it's probably going to be a curveball thrown at us when we're not expecting it, okay? So there's more in here, but I'd like to move on. I think you know where I'm getting at with this one. Christine Lagarde, the head of the IMF, had some interesting things to say as well. 6 months ago, I pointed to clouds of risk on the horizon, and I actually covered this in a video, and I think it's important to understand the fact that she said today some of those risks have begun to materialize. I agree. And when I look at this, I have to understand that, yes, Christine Lagarde, head of the IMF, there's an agenda there. I'm not denying that. But I think that it is important to focus on the problems. And the problems are very, very evident today. There's too much debt. There's too much risk that has been going on. I covered that in many of my other videos here. When they're looking at the trade issues that I think are going to escalate much further, you saw what just happened with this whole new secret chip that is in all of these different computers and servers and all these different things that have been come to light about, China's putting it in there as a backdoor. I don't know if that's necessarily true or whatever, but that's just going to make all of these problems much, much worse right now. Okay, so she covers more in here, but I'd like to move on into this. Now, you probably know the EU Commission President, Juncker. You know Juncker, the junk? One crisis was enough. After the toughest management of the Greek crisis, we have to do everything to avoid a new Greece, this time an Italy crisis. And so obviously they want Italy to give up their sovereignty. At the same time, they want Italy to be able to have these measures imposed on them when, of course, they can't. A country like Greece, a country like Spain and Italy and Portugal even cannot have the same rules applied to it that a country like Germany has. It's not going to work. It's never going to work. And that's why we have the problems we have today. You have to get your deficit down to this level. You have to get your debt over here. You have to use this interest rate. You have to use this currency. And then they wonder why it doesn't work. Come on. This is ridiculous. And of course, the goal here is to ensure that every single country gives up their rights in order to have the rulers from on top decide everything. And the way you do that is putting the country into debt. And this is funny because I hear it all the time, constantly, basically every single day, within individuals in the financial industry, as well as individuals who don't know the back of their own hand. But anyway, it's very important to understand debt, because debt is the system of control used by the central bankers intentionally to control people, corporations, and countries. And they're doing so today. Italy should stick to its promises and respect Europe's fiscal rules, according to a member of the ECB. This is an article out of CNBC. The comments, Olli Rehn, he's the governor of the Bank of Finland, and he's a member of the ECB Governing Council. How did he get on the ECB Governing Council? Just as everyone else does. You didn't vote him in. People in Finland didn't vote him in. People in the EU didn't vote him in. They're just put in place and you don't get to decide, all right? So that's the way this works. But hey, nobody seems to be worried about it. It's just me. Oh, well. Now, they're talking about Italy and all of the situation that's going on there. First, Italy said, there's no way we're going to follow this rule. We're not going to put our deficits in here. We're going to be able to spend more money because we need to get out of the problems. If we don't spend this amount of money, we're going to be in a much worse issue next year, 10 years from now, and so on. And so they first didn't agree to it. Then I heard that they were going to agree to it, and I think they're just not going to do it anyway, but they're just going to say that they will. So we'll see what happens. It would be very much appreciated if Italy were able to stick to its promises and stick to its commitments as regards to the stability of the growth pact, the set of European fiscal rules, because we all live in the euro area and every member state is expected to respect the rules. And from his point of view, or looking at this, I agree. They should be able to respect the rules. But there shouldn't be a bunch of rules in place, and there shouldn't be an EU, and there shouldn't be a euro, and so on. But hey, that's just me. Now we look at this chart here very quickly. I got a few charts to show you, in fact. See what happened here. Now, they're matching up these charts, and when they show a matchup of charts, it could be done in any which way. It made to look like this, and I wouldn't put too much on it. But just what I have to say here. When we have a dead cat bounce, and this was experienced in 1929, you could see that with the blue line, where you had the market rising, okay? Then it falls, a significant fall in this case, and the market decided to come back up, but it ended up falling dramatically yet again. And from the highest point to the lowest point, it dropped 89% based on memory here. It dropped 89%. So people got in, they thought it was the right opportunity because they saw everything was going to be fixed and so on, and they ended up losing even a lot more money. And sadly, that's really what a lot of markets do occasionally. You'll see that come up. Not always, doesn't happen every year, doesn't happen in every market every time, but this is generally what occurs. There's always a dead cat bounce. People come in, try to buy up the dip, and it works in some cases, but eventually they get hit really, really hard. They get punched in the face. It's a sucker punch. Is that going to happen this time around? I really don't know, because when I look at this, I struggle to see the reasons why it's going to happen tomorrow. And that's the way the market trades. The market trades based on today. We need a trigger event. Definitely, if something happens to Italy, that's it. It's over. It's over and done with. The market's going to spill out its guts. But they can easily resolve that by printing, a few more trillion, pump it in there. They say they won't. Will they? I don't know. But at least the risks are definitely present. Okay, so I want to look at where the risks are, and I want to address that on a day-to-day basis. That's why I do these videos all the time. I get criticism for covering the same information, but it's new charts every single day. But regardless, anyway, we have been here before. Each trough has been followed by a recovery. Percentage of funds outperforming S&P 500 on a 5-year basis. And I just look at this and I see the patterns forming. You saw that in 2000. You saw that in the late 80s and so on. And I have to say, hey, we're basically at the same point again today. Now, whether or not that's going to translate into the next financial crisis, I don't know, but I just wanted to show you that because it's very important to always track these different indicators. There's thousands of them out there. Stocks fell sharply on Thursday as interest rates hit a new multi-year high, dampening investor sentiment. Don't worry about it because the Dow Jones dropped 300 points, but I assure you it's going to climb in no time at all, with buying the dip always being the retail investors' happy decision to do so often anyway. But looking at this, the NASDAQ even took a beating. Facebook, Netflix, and Alphabet all dropped more than 2%. Now, I want to show you something. They mention it in here, the 10-year Treasury note, reaching its highest level since 2011. Take a look at this here. As you can see at the chart form, that should be worrisome because when this event occurs, when we hit back to these levels that we see consistently, then it becomes a problem, not just for the US, but for the whole world, because this tends to be a leading indicator of a recession. Is there going to be a recession tomorrow? You tell me. Everybody seems to know the answers. I certainly don't have them, but I can tell you right now, this is not looking good. The 30-year yield is back to levels we haven't seen since 2014. All right, so keep your eyes on these. This is starting to become a problem. When you see that the Federal Reserve increases interest rates on very, very small amount and then it has an immediate impact, I start to think, okay, where are we heading? All right, so that's really what I'm looking at. And then we have the real economy. We can look at charts all day, but the real economy continues to slide. And this is showing us basically that Sears and Kmart, they're closing more stores. I don't even know how they have any stores left. This shows you how many stores they had open. Looking at this here, as of August 4th, the company still had 506 Sears locations. That's interesting to me. I really thought they would have closed them all by now, and they probably will. It seems like it. This is the case of many factors here. Obviously, e-commerce is playing a role. Obviously, there's newcomers coming onto the scene. A lot of individuals are purchasing from different stores today. They're purchasing online. They're purchasing at different big box stores. There's a lot of changes going on over the last, let's say, 20 years, definitely. But I would have to say overall that the weakened economy is, basically creating a narrowing band of stocks, a narrowing band of housing that's rising, and a narrowing band of stores and businesses that are doing well. Okay, I'm going to end the video there. If you found it informative, please give me a thumbs up. I'd like to know what you like about these videos in general. Just name a point. If you just say, okay, it's the way that you cram everything together in one video. It's the way that the format you do is that you cover unique information or whatever it is. Just let me know. Just let me know one point that you like about the videos, and I really appreciate that when you do so. I'm reading the comments, so please understand that. And I value your opinion. I'm not like some other individuals out there who I know specifically never read the comments. Maybe it's because they don't want to hear criticism, or maybe it's because they just don't give a damn. I don't know. I read the comments every single day of my life. So that's all. If you want to check out my books, this is the financial education that you were not taught in schools. I cover everything you need to know. You'll learn everything from A to Z. You'll get all the information you need, and that's available at the link in the description. It's on Amazon. I'll take you over there. If you're more interested in the audiobook version, you can get that at themoneygps.com.